So I wanted to do a video on how you can become your own central bank, where you can print your own currency. That's right. You can print your own currency and use that currency to go and buy gold and silver or any other asset you like. Now, I'm going to talk a little bit more in future videos about options and selling options, where you create currency out of thin air. By selling an option contract, you create currency out of thin air, and then you go and use that currency or that premium to go and buy gold and silver or any other asset. But I realized I've already done a video. As I was putting this video together, I've already done a video discussing this, which most of you haven't seen because it was one of my very first videos I did on this channel. So instead of recreating a whole new video on selling options and printing currency out of thin air, and then using that currency to create even more wealth by buying more real assets, I thought I'd just replay this old video that I did. So hope you guys enjoy it, watch it, and learn. And feel free to reach out if you want to learn more about how you can become your own central bank, print your own currency, and use that currency to buy real gold and silver. Enjoy. Well, welcome back to Finance Uncut. On today's episode, we're going to discuss how Warren Buffett uses options to literally print money and how you can too.
So let's quickly get into why Warren Buffett is an options trader. And you're probably thinking to yourself, what is Warren Buffett doing with options, right? Like, he's a big stock guy. He's a huge proponent of long-term investing. But the reality is that when you actually dig into what he does, you'll see that he's actually really, really big-time options trader. Now, again, just to be 100% clear, I'm not saying that he just trades options, but he does recognize the huge opportunity to use them as leverage for his portfolio, and he's made a ton of money doing it. So let's look inside Berkshire Hathaway's annual report real quickly. This is where we're going to see how he's trading options in a big way. And again, this is all public information, but what you have to understand is that in the last 3 years, he's made $5 billion in profits trading options and specifically selling options, which is what we talk about here. So if it's good enough for Warren Buffett, don't you believe it's good enough for yourself as well? All right, so let's get into it here for a second. So here we are inside of Warren Buffett's 10K for 2014. So at the time of this video, it was not available for the 2015. It's going to be exactly the same because the market was pretty much flat this year. But inside of his management discussion, and again, this is all public information, page 51, you can go back here and check it if you want to. He talks about all of his derivative contract trading, and especially equity index put option contracts that he sells. And he lays out in this entire report exactly how they do it. But here's the key. In 2014, they produced a pre-tax gain of $506 million. In 2013, he produced a pre-tax gain of $2.6 billion. And in 2012, it produced a pre-tax gain of almost $2 billion. Now look, again, at the end of the day, I'm not telling you anything that's fluff. This is all information you can back test, check, look at it yourself, but the numbers are here. It doesn't lie. He's doing options trading, specifically selling index put options in a huge, huge, huge way, and he continues to do so. In another page, this is page 96, if you want to go back here and look at it, he talks about, basically the net fair value of what he's got right now, which is $4.5 billion of kind of leftover equity index put options. And he talks about how they determine their valuation, which is option pricing, which we just talked about, and basically their biggest input, which is implied volatility. And look, again, he lays out the entire thing here for you so that you can see exactly what he's doing. And it's not that he doesn't talk about this, but I wish he were to talk about this a little bit more, because you can find it every single year, every single quarter, that he's a consistent and reliable option seller that recognizes how implied volatility is overstated. So again, if it's good enough for Warren Buffett, it should be good enough for you.
So at the annual Berkshire Hathaway shareholder meeting in 2019, you can see here that Berkshire collected $7.6 billion in premiums from 94 derivatives contracts. All right, so how Warren Buffett made $7.5 million in under 5 minutes, which you can use this same strategy. So when most people think about Warren Buffett's investing strategy, they think of buy and hold. Pick great companies and hold on to them forever. While Buffett does have a reputation for holding onto companies for many years, that's not the only way he's built up his wealth. Warren Buffett trades options from time to time to collect premiums while waiting for stocks he loves to hit certain price points. Rather than buying options, Buffett sells options. Selling options turns you into the casino rather than the gambler. When selling options, you have two choices, the covered call and the cash secured put. For a covered call, you already own 100 shares of the stock. You can sell a call and collect premium just for the stock sitting in your account. Now, let's get to Buffett. So how did Buffett make $7.5 million in under 5 minutes? Well, years ago, Buffett sold puts for Coca-Cola back when it was $39. Buffett loves Coca-Cola stock, but he didn't want to buy the shares at $39. Instead, he wanted to buy them for $35 a share. Rather than create a limit order that went through when Coca-Cola's price hit $35, Buffett decided to sell 50,000 Coca-Cola puts with a $35 strike price. Since each option is for 100 shares, Buffett's 50,000 Coca-Cola puts were a bid to buy 5 million Coca-Cola shares at his desired $35 strike price. These $50,000 put contracts provided a $1.50 premium for each share, which resulted in an instant $7.5 million windfall. And it literally takes under 5 minutes to place this trade, and that's how he made $7.5 million in under 5 minutes. You can immediately use the money you earn for premiums to invest in other stocks or pay off expenses once the money settles. In the meantime, you'll get shares of your favorite stock at lower prices than what it's currently trading for. Now, the only two risks of this strategy are, one, the stock can go lower than $35, but you're obligated to buy it. This isn't a problem if you plan on buying the stock and holding it for the long term anyway. So what Warren Buffett is doing with selling naked puts is he's providing insurance to the market. So people who currently own Coca-Cola stock, he's providing insurance. He's saying to them, look, if this stock falls below $35, I agree to buy it off you at $35, and they pay him a premium, just like insurance. And number two, the stock never hits your strike price. This isn't entirely bad, as you still get to keep all of the premiums, and you can keep doing it over and over again until the stock hits your desired price target. Now, I've done a lot of naked puts in my time, and very rarely am I actually ever exercise. So I actually never buy the stock, but I get to collect those premiums and then reinvest them into buying more stock or so forth. Well, actually, that's what I do. I buy more stock or more assets of like physical gold and silver coins or bars or whatnot. Not everyone can sell 50,000 put contracts on Coca-Cola. Cash secured puts require that you have enough cash upfront to make the purchase should you be obligated to buy the shares. At a $35 strike price, a single cash secured put contract would require you having $3,500 in liquid cash available for the trade. You don't get access to this cash again until the put is exercised, gets expired, or you decide to buy the same put to close out the contract. So you do have to have that collateral or the cash in your brokerage account so that if the stock does fall, that you've got the cash to meet your obligation. So it's tied up there until either that put is exercised, gets expired, or you can buy the same put and close out that contract if you no longer want to be in that trade. Even so, a single Coca-Cola put would have resulted in $150 in premiums, which is good for an instant 4.3% gain. And that's the key. It's these lots of little gains that we get that add up over a 12-month period, and we reinvest those earnings. We do the same thing the following year, and all of a sudden you've got some serious compound growing happening. And the possibility of buying Coca-Cola stock $4 below the current price. So you're buying it wholesale, you're getting a discount, and you're getting paid to buy it at a discount. That 4.3% gain is more than Coca-Cola's dividend yield, and you receive the money up front rather than waiting for 4 quarterly dividend payments. Buffett frequently uses options and other derivatives to build up his portfolio. While the majority of his strategy is buy and hold, derivatives can allow for otherworldly gains or a steady stream of passive income that protects you from some of the potential downside.
Between 2004, I think, and 2006, I think we wrote 48, maybe 50 contracts, something like that. The shortest was 15 years. The longest was 20 years. And we received, as I remember, roughly $4.8 billion, which we were free to do with what we wanted. And we agreed to pay based on where one or more of four indices were selling for at the time of expiration. They were so-called European-style puts, where they're only payable based on one date. And we did not have, with a small exception, we did not have to put up collateral, which was part of the deal. And we've had that $4.8 billion. We probably had an original nominal value of something over 30 billion, maybe 35 billion. That's if everything went to zero. I mean, if Dow Jones went to zero, the FTSE went to zero, and the Nikkei and so on. A number of those have run off. So we now have about 14 billion nominal. We have something less than half left. We haven't paid out anything significant. We bought back a few of them. If everything went to zero, we would owe 14 billion. If everything were to sell at the same price it was selling for on March 31st, I think the number is I think it's somewhat less than we carry as a liability on the balance sheet, which is 2 and a fraction billion. So far, so good. I mean, we've had the use of a lot of money, and the outstanding potential of them is if the market went up a lot, we wouldn't have to pay anything, and if it goes down some more, we have to pay more than a couple of billion, but we've got the liability set up for that. But so far, so good on that, and it is not anything that causes us any problem. They come due, the final one I think comes due sometime in 2023. I think there's, I think maybe 20 or 25% of them come due late this year, and so it's there's nothing that the questioner doesn't really understand about them. I can tell by the question, and there's no surprises there. There's no way that some liability could double up on us except based on except relating to where those indices close at the expiration of a group of different puts, which, like I say, have been more than cut in half. And we've done very well on it.
So far in this video, we've looked at how Warren Buffett predominantly uses naked puts to generate cash flow or passive income or profits that he uses to reinvest into buying more stock or building up his cash position. However, I don't want to focus too much on that. It's probably a little bit more sophisticated than the covered call option strategy, and that's simply because you need to have the skills to be able to value stocks. One of the risks is if you sell a naked put on a stock and it does go to zero and you've offered to buy it at $35, well, guess what? You've got to buy it at $35, even though that stock has now gone to zero. Very rarely does that happen, but you do need a little bit of sophistication, a little bit of experience to do that. But a lot of you will own shares, especially blue chip shares, in maybe a self-managed super fund or outside, just in a general portfolio. In Australia, maybe you've got the banks, BHP, Rio Tinto, Telstra, a lot of the blue chip stocks, and you might be getting a 3, 4, or 5 or 6% dividend yield depending on which stock that you own. Now, a covered call can generate even more profit, even more passive income, even more cash flow than just the dividend. And since you've already owned the stock, well, this is a strategy that you can do. So a covered call option is a two-part trade. First, you buy the shares and you sell a call option. A call option is a financial contract between two parties, the buyer and the seller. Every option contract has both a taker, or the buyer, and predominantly everyone, most mums and dads or small traders are buyers because they see the upside potential. However, you need to look at what the potential to profit is. So they look at the profit potential, not the potential to profit. And I'll speak a little bit more about that at the end. And a rider, or the seller. As an option seller, you can generate monthly income. What is a call option? An option is a contract which gives the buyer the right, but not the obligation, to buy shares at a specified price on or before a specified date. The seller, or the rider, is obliged to sell the shares at the agreed price and date. How do you earn income? Well, first you buy the shares which you own and write a contract to sell those shares at a certain price by a certain date. And the buyer, or the taker, pays you a premium for the contract. So let's say that you bought 5,000 shares of Qantas at $1.14 per share. Now, this is going back 2014 when this was the case. Qantas is now around that $5 mark, keeps going a bit above and a bit below. But let's say you bought 5,000 shares of Qantas at $1.14 per share, and you sell 50 call options at a strike price of $1.15. So we'd call this at the money, because you bought it at $1.14, you've agreed to sell it at $1.15. So there's a thing called at the money, out of the money, and in the money. I used to sell a lot of at the money or even in the money for big premiums. Nowadays, I buy value stocks and I write out of the money call options and generate both premium, but also a lot of capital gain. Now, the contract expires in less than a month. So I always do short-term options. When I'm selling options, I want the time period to be as short as possible, because that gives the buyer of the option less time to be right. If I'm selling longer term options, I'm giving the buyer a more chance to be right, especially when it comes to calls. Puts, that's another story. Now, you earn 6 cents a share, which is $234, or a 4.11% return. 50,000 shares, and you earn $2,340. So what does this mean to you? By selling the call option and getting paid for it, you're obliged to sell the 5,000 Qantas shares at the strike price of $1.15 to the buyer any time between now and the date of expiry, if you're called away by the buyer. So sometimes it can go above the strike price for a short period of time. However, you're not called away by the buyer, and then the price of the share falls back below that strike price. But you also got to take into account the strike price plus the premium paid by the buyer before the buyer of the option is profitable. So you get to keep you get your investment back and keep the premium, or you keep the shares and keep the premium, either or. So there's two possible outcomes with covered calls. If Qantas is below the strike price of $1.15, the option expires worthless and you keep the shares and the premium. And then guess what? The following month, you write another covered call. If Qantas is above the strike price of $1.15, you sell your shares at $1.15, make a small profit, and keep the premium. So what does this all mean? If you buy or own shares, you can write call options each month and earn income. These are called buy rights. Shares generate income. And can I tell you, this is my bread and butter trade. This I just love. I just literally month after month, year after year, it's just so easy to print currency. I hate using the word money. Currency, which I then use to buy more shares or more gold and silver. Buying shares and writing seller calls outperforms owning shares alone. So you can see here, buy right strategy, a growth of a $10,000 initial investment. So if you were to use the buy right strategy, you outperform because you're generating more income, reinvesting that to buy more stock, following month, writing another cover call, probably getting a little bit more premium because now you've got more shares, so you can write some more contracts, and then so forth and so forth and so forth. So here's an example of a trading plan of $100,000. Now, this is an old trading plan, so you can see this is an old presentation that I've done. Probably should update it, but anyway. So we've got, what do we got there? We've got DJs, Fortescue Metals, Fairfax, Newcrest Mining, and Qantas. And you can see the number of shares that I own, the option contract. So there's 100 shares to one option contract. There's the share price. That's what it costs me. Then the equity or the brokerage, the strike price, the premium that I received. So you can see the difference between the share price and the strike price. So some are at the money, some are out of the money, and none are in the money. The brokerage, and then you can see the net profit not exercised, and you can see the return there. So 2.67%, 3.15, 4.62, 4.9, 3.3, and then you can see exercised. So if I was exercised plus the brokerage. So if you look right down the bottom, so a total portfolio of $100,000 or just over, I made $3,702.50, which is a 3.7% return. If I was exercised, that would be a $4,417 profit or a 4.41% return. So you can see how easy it is if you have a portfolio of blue chip stocks where you can sell options or sell calls to generate cash flow. Now, this is the example of the $100,000 trading before on the last slide. So $100,000 or just over $100,000, say 30 days, not exercised, got a 3.7% for the month or $3,700. If I was exercised, well, you make a little bit more money. So you can see that there. Now, let me throw this out there. Let's say that you had a particular home loan product, a master limit product, where you can actually pay your home loan off in under 10 years, while at the same time building wealth for the future. And I'll do a video after this explaining this master limit product. There's only a couple of banks in Australia that offer this particular product. But let's say you had this product and you were able to borrow an extra $100,000. So you had your initial $100,000 or $193, and you're able to borrow another $100,000 using this master limit product. It's a home loan product. Now, the interest rate on the investment portion of that master limit product is 3.49%. Now, that product is not a margin product. So if the stock does fall, you do not get a margin call on this. And that's the other benefit of a master limit product on your home loan. So the interest rate is 3.49%. So the interest is $290.83 per month. Now we got those returns, 3.7 and 4.4. However, now because of that extra leverage, by not being exercised, you've generated just over $7,400 for the month. If you were exercised, you've generated over $8,800 for the month. Now, when you take out your interest that you just paid for the month, your net profit is just over $7,100 for the month, or just over $8,500 for the month. So you can see how powerful it is using a little bit of leverage, but using a smart product called the master limit product on your home loan, which actually what you do then is you take that income down the bottom there, that's $7,000 or $8,000, whichever happened for the month, and you pump that through your home loan to pay down your home loan, and then you basically debt recycle it through the investment side of it and buy more assets or buy more stock, write even more covered calls, make even more premium. So you can see it's very, very powerful. So on a $200,000 portfolio, you can actually see the type of monthly income that you can generate. So a covered call option is when you own the shares and sell someone the choice or option to buy your shares at a price you both agree on or before an agreed date. Before you enter into this contract, you need to know a few important things like share price, contract size, strike price, premium, and how much you make, both exercise or not exercised. However, I definitely recommend you do a little bit more research, and these are some of my favorite books that I would recommend. Funny enough, the book on the right, The Lazy Trader, down the bottom, Neil Godwin. Neil is actually a client of mine, and he's been a full-time investor writing cover calls since the early 1990s. So he's practically been retired, traveled around the world for 12 months, lives a very, very good lifestyle doing this. And he's a client of mine. He was the second person to introduce me to this a long, long time ago. Get Rich with Options at the top right is one of the best options books, one of the most simple option books. And it actually goes through a few different option strategies, but it also gives you the stats. So when I was saying before about people like to buy options because of the profit potential, in this book, it lays out the stats about the potential to profit. What I mean by that is something like 94 and 96%, the numbers are in the book, of people that buy options lose money. So those option premiums expire worthless. So on the other side of it, those that are selling options are winning. They're taking lots of little wins along the way. The Intelligent Option Investor, very good book. On the left, Covered Calls and Leaps. Leap options is another strategy that I do, which I actually learnt from Joel Greenblatt in the book next to it, You Can Be a Stock Market Genius. And there's a couple of young fellas in the movie The Big Short that also picked up that book and learnt that strategy of leaps, and that's how they generated a lot of their wealth. Naked Puts down the bottom left, if you want to learn more about how Warren Buffett uses, in particular, naked puts to generate that premium. You can see I'm a big Joel Greenblatt fan, my favorite all-time investor. I've put his 3 books up there: The Big Secret for the small investor, You Can Be a Stock Market Genius, and The Little Book That Beats the Market. And then a couple of Buffett type books there, Value Investing and Buffett Beyond Value. So if you want some more information on covered call trading, definitely get those books. However, feel free to send me an email at jsinvest@firstchoicefinancegroup.com.au, and I'll personally email you a link with a whole bunch of information. Also, the ASX options course, which you can do for free. I highly recommend it. But I'll give you some wonderful little books to so that you can do some further education on covered call trading in particular. So I'll send you an options pack with presentations, ebooks, and templates, the ASX options course. And I also recommend for my American friends or even my Australian friends is if you listen to podcasts, check out Tyrone Jackson's Trading Stocks Made Easy podcast. So anyway, guys, if you like this video, hit the like button. Look, share the channel with your friends if you think I provide good content here. Love to get all this content out to more people. So yeah, please share it. Love to see your thoughts and opinions in the comments below. Otherwise, I'll see you again on another episode of Finance Uncut.